Hi there, this is JR from jrfibonacci.wordpress.com and from thedominoileffect.com. This is Buyers Markets and Rising Risk. The risk is rising in real estate, in the insurance industry, and speculations of gold and silver and stock markets. So many risks so many markets have rising risks these days. So I'm making this little presentation here to bring some clarity to the subject. Prices only collapse in particular conditions, right? Two general terms for contrasting market conditions are sellers' markets and buyers' markets. A buyer's market means that the buyers of that particular type of purchase have the advantage. In brief, a buyer's market is whenever there is more offers to sell than offers to buy, or bids. When there's a growing imbalance between the many numbers of offers to sell and few offers to buy, then the relative cost of a purchase tends to decline. When there are rising numbers of offers to sell and few offers to buy, then the relative cost of a purchase tends to decline. If selling pressure floods into the market at the same time as buying pressure is withdrawn, prices can suddenly collapse. An example of buyer's markets would be when there is a very low employment rate in an area and a truck shows up where there are a bunch of able-bodied and willing workers and there is an announcement of work available. What happens? People may crowd together or line up in order to get selected early and be hired and earn their pay. If there are only two employers in an area and then one of them leaves that area, what happens? The cost of labor for the remaining employer can plummet. Why? Because suddenly jobs are much more scarce and available workers are more plentiful. All the people who were working for that company that used to be there, they're still there, and that company isn't there. So there's the same number of jobs at that one company, which means about half as many jobs as there were previously. And there's now twice as many people going after half as many jobs. What's going to happen? The price of labor can plummet. So in buyers' markets, the buyers have the advantage because the buyers are relatively scarce, meaning that there are a lot more sellers than buyers. So that, in an extreme case, the buyers are the one who can publicize to the sellers, hey, I'm buying. Look over here. Here I am. I'm buying. I'm the only one buying, or I'm one of the very few who are buying. And then they can just wait for the sellers to come to them and compete against each other to get the business of any particular buyer. There's a large supply of whatever is being sold relative to the existing demand to buy that purchase. In the case of labor being sold, or could be houses. If there's a lot more houses being sold relative to the demand to buy that purchase, well, what's going to happen? Prices drop. If there's a lot more offers to sell silver than people who are seeking to purchase silver, what happens? Prices drop. Stock market. If there are a lot more offers to sell than the demand to buy that particular stock, what happens? Prices drop. So another way to describe a buyer's market is a market that is saturated or oversaturated, meaning there's a lot more supply available than the demand available. So the opposite condition is a seller's market, in which offers to buy are quite plentiful and offers to sell are scarce. For instance, when qualifications to get real estate financing are reduced, making it easier to get real estate financing, that can produce a flood of newly qualified buyers. All of a sudden, there's all these people who qualify that didn't qualify before. So let's say that a government program subsidizes purchases for a particular favored population, such as military veterans, at the expense of all other taxpayers. Further, let's say that lenders reduce the qualifications for a loan, maybe for a particular group or for all groups, such as reducing the credit score required or reducing the down payment rate from 10% to 1%. We can see how this would increase the number of qualified borrowers, right? And by qualified borrowers, we mean people who can qualify to make a purchase of real estate. So further, let's add, not only is there government subsidies for a particular population to favor them over all the other taxpayers, and not only is there a reduction in the lender's requirements to qualify to borrow, maybe instead of 10% down, only 1% down, or lower credit score, or something like that. But even beyond that, let's add that there's a natural disaster. I mean, it's already predictable what's going to happen to prices in the instance I just gave. But let's add a natural disaster, such as a wildfire, that suddenly destroys 30% of the homes in an area. What's going to happen to prices? For those remaining 70% of the homes, now that they're 100% of the homes that are left, right? What's going to happen to those homes? There's a lot less homes than there were like a week before. Qualifications to borrow are greatly reduced, so there's a huge number of people who are suddenly qualified. Plus, there's some subsidy, like for military veterans or whatever group. There's some subsidy, so of course there's going to be a big surge in buying, or it's predictable that there could be a big surge in buying and a big increase in prices. In that case, we have a sudden reduction of the number of homes available, plus a sudden increase in the number of qualifying borrowers, such as from higher risk lending by lenders and or government favoritism to subsidize a particular group's purchases. So what's likely to happen to prices? If only temporarily, prices tend to increase when there's a relative increase in buying pressure over selling pressure. Again, it could be temporary. It could be that the next year, maybe when the tax credits expire, or the next decade, or at whatever point in time. Maybe it takes a while to rebuild houses that were burnt down in the wildfire. Maybe they're never rebuilt, but at some point in time, that sudden increase in buying pressure over selling pressure won't be such a sudden increase, such a big increase. There could be small increases over time, but they won't be as big as that one. Or maybe there would be a decrease in buying pressure. Maybe selling pressure would really increase and buying pressure would decrease. Maybe people who had been buying will want to sell. Maybe they find out that the insurance company that they thought would be available to cover their home in the case of a wildfire, maybe that insurance company goes bankrupt and they no longer offer insurance policies to cover that area. They just say, oh, it's too risky, too many wildfire risks in that area, we won't cover those homes. What would happen then? Well, of course, prices would decline, right? So once that new wave of buying is complete, after there's some sudden change to market conditions, like much easier qualifying regulations to get borrowing. So once that wave of buying is complete, as most of the people who suddenly qualify may complete their purchases, then there would be very few prospective buyers left. Like everybody who is going to buy in has bought in. That's another saturation. Where would the next wave of buying come from? In the absence of a sudden decrease in the number of units available for sale, like another wildfire, prices eventually could be expected to come back down toward prior levels, especially if the policies end that had increased the buying pressure, right? Like the 1% down requirement is lifted back up to 10% down or 50% down. Well, that's going to reduce the buying pressure, right? Well, what if the government's program is merely decreased? Maybe they don't, discontinue it completely, but they just decrease it. Well, that's gonna decrease buying pressure. Prices would come down. In a seller's market of relatively scarce supply, a salesman can come into a public area with an announcement of their offering, such as snake oil, and people may crowd together in a bidding war to get one of the very few bottles of snake oil, or bottles labeled snake oil at least. And similarly, an auctioneer can announce foreclosure auctions, today at noon, and then a herd of people will gather into a bidding war if it is a seller's market in which there is relatively high demand for whatever is being sold. If that's the only snake oil salesman, if that's the only one having a foreclosure auction, and there's lots of eager buyers, wow, they're just going to congregate. They're going to group right there at the auction. It's going to be a bidding war, right? Or in the case of recent real estate markets, as changing lending policies produced huge surges in the number of qualifying purchasers. Sellers can just list their home for sale with a realtor and just wait for the bids to come in. A couple of weeks later, they've got more than one bid, maybe. In a true seller's market, owners do not even have to list their item for sale, and they may get offers to buy anywhere. Buyers will just come and say, "Hey, you've got that? I don't know if you want to sell it, but I'll offer you $500,000 for that house. I've got qualified financing. I just like the looks of your house. I want this. Is a great location for me. How about $500,000? Will you let me do a walkthrough?" They're just really aggressive sometimes, right? So buyers do not even wait for offers to sell in extreme cases of sellers markets. There's like a mania, right? So another common example of a seller's market would be when a big business operation such as a government, is inviting bids to perform a particular construction project. The herd of contractors learn of the opportunity, they research the project, and then make their bids. From all the bids submitted, a selection can be made. The seller does not need to do much to attract the attention of a herd of buyers during a seller's market. They just announce, "Hey, we're accepting bids for blah, blah, blah," like printed in the newspaper or whatever, and the next day, there's 10 bids come in. The next day, 40 bids come in or whatever, and that's it. All they had to do was print one announcement or something, or post a notice on their bulletin board because people were coming by every day looking for work. They want to have, a government contract to build something or repair something or whatever, and they're coming over and looking, "Hey, do you have anything? Hey, are you guys hiring?" That's a notable situation, right? So why do prices collapse when a seller's market shifts to a buyer's market? One thing is that everyone who owns a particular type of item has been thinking that recent market prices reflect the market value of their item. So a few units of a particular thing sold recently for a certain price, and everybody thinks my home is worth what that comp sold for last week, last month, last year. Everybody else thinks my home is worth that. My home could sell for that. But if everybody tried to sell their home this week, they wouldn't get anywhere close to the comp that was gotten, a few months ago in many cases. They might, but if everybody tried to sell all at once, well, that means there's no buyers. There's all sellers. If there's all sellers and no buyers, then the market price drops to zero, or towards zero at least. So, using recent market prices of a few similar units as a compatible, or as a comparison to a compatible transaction that recently happened, that's how accountants and tax forms instruct us to estimate the value of something from a comp or a recent transaction price for a similar purchase. And that's a perfectly good estimate. It's a good method for estimating. It's just important to know that's a method for estimating. And if all of the people that have homes in an area sell all at once, or list their homes for sale all at once, they're not going to get anywhere close to the price when 1% of the people are listing their homes for sale. So imagine that there are 1 million tons of silver actually available for sale. And on a typical day, imagine that only 100 tons are actually exchanged in transactions. Maybe this is for a particular exchange, such as the Chicago Mercantile Exchange, or COMEX. So people look at the going rate for the sale of 100 tons of silver, the daily rate from the day before, and they think that if all the other 999,900 tons of silver, the rest of that million, were to be sold on the same day, the price of all million, all of that, would be the same as the price for the first 100 tons sold that day. That's like the general presumption that people make. However, that is ridiculous. But that is the conventional method of accounting the value of all million tons of silver, all the silver that's available. People think, we'll just take the price of a small amount of units, small volume of transactions, and we'll figure out that's what all of it's worth. That's inaccurate. That's not even really logical, but that is a way of estimating. It's not a bad way of estimating necessarily. It's just an estimate. We would have to agree that it is a exaggerated estimate. The question is, how exaggerated is it? Obviously, if somebody tried to sell 1 million tons of silver and into a market where typically only 100 tons of silver are selling daily, they're going to blow out the prices. That means we're putting silver on sale today only. We've got to sell it all by the end of today. It's like, one of those car lots or going out of business sale for a furniture store or something. We've got to sell it all by 5 p.m. today. Make an offer. Come in and make it. That's the deal. So what silver sold for the day before when it was only selling 100 tons, that's irrelevant. When somebody's going out of business and we're going to sell it all today only, no reasonable offer will be refused, whatever. That means prices are going down. So that is how silver prices can fall 19% in one day, such as in April of 2006. In the case of certain changes to qualifications to borrow money to buy silver, like margin regulations, then the fundamental naivety related to that whole logical fallacy can be quickly revealed. It's naive to think that the daily price for selling 100 tons of silver is a decent estimate for what the daily price would be on a day that 10,000 or 1 million tons are suddenly made available for sale. It's a high estimate, an extremely high estimate. We don't know how high. We just know that's like an estimate on the high end. It's not a bad estimate. It's a simple, easy estimate, and it is an estimate, and it's on the high end. So unless the buying pressure also increases to meet the new selling pressure, let's say of 10,000 tons of silver rather than 100 in a normal day, unless buying pressure meets that new selling pressure increase, well, of course, prices will plummet. So then I show a chart of Enron stock prices for just a couple weeks in November of 2001. It went from around $12 a share to around $7 a share. Consider the stock prices of a large, stable corporation such as Enron, at least one that seems stable. People believed it was stable. One day there may be 1 million shares of Enron available in the marketplace, but imagine that only 100 are actually sold in a typical day. The share price might be $7 or $8 on a typical day, such as November 20th, 2001, shown above in the chart there. But then, what if the next day 100,000 shares of Enron are placed for sale at market price, like all at the very beginning of trading the next day? Well, if there are not 100,000 offers to buy or bids waiting to match all 100,000 offers to sell, then the market price of the remaining unsold shares listed for sale, like the other 900,000 or whatever, that falls to zero. There has to be bids on the exchange for untransacted bids that don't have matching sell orders. There has to be people making bids in order for us to have any perceived market value for us to say, well, here's what the other million are worth up to such and such amount. Of course, some buyers may show up on the next day and purchase the remaining shares that are unsold, like say, that they just don't get sold that day and the prices fall officially to zero. Well, then the next day, some people might come, or the next hour, or whatever, some people might come in and purchase the remaining shares and purchase them for something like 30 cents per share, maybe 1 cent per share, whatever it is. So they get 99,900 Enron stocks for 30 cents each. So what happens though with the other 900,000 shares? There were 1 million total, right? So we sold 100,000 for 30 cents instead of $7. What happens to those 900,000 that were estimated as worth $7 each on the day before, and they're now worth 30 cents each? What happened? Well, nothing. We got a more accurate or more updated number for us to calculate the actual value of those 1 million shares or those 900,000 remaining if they were all to be put on the market at once. So the prior estimates overlooked that there suddenly could be a relative increase in selling pressure. If selling pressure rises dramatically and it's not matched by a sudden rise in buying pressure, then prices plummet, whether that's prices of silver or Enron or anything else, real estate, insurance policies for a company that's officially bankrupt. Okay, I got an insurance policy from this company. The company no longer operates. How much is the policy worth? It's worth zero. Once I recognize that the company is no longer in business, then I recognize, okay, this is worth zero. It's worth nothing. So stunning collapse of Enron stock price. It rose up to $85 per share, and in a little over a year, dropped to pretty much zero. So there's a chart of what happened when a lot of the owners of Enron stock wanted to sell Enron shares all at once, more or less, and very few people wanted to buy it. It fell from every single share of Enron being accounted as worth $85 a share to zero. Here's a similar chart for the entire stock market of Japan, peaking in 1989, and then the trend of more buying pressure than selling pressure reversed to more selling pressure than buying pressure. In other words, more selling. The Japanese stock market is still down about 80% after 21 years of so-called recession. Well, how long are recessions? 21 years so far, huh? Down 80%. That's interesting. So when oil prices doubled in less than a year in 1999, there was a relative increase in selling pressure in the sector of the U.S. stock market for airlines. That's a stock sector that uses a lot of fuel, right? So fuel prices, in particular oil, doubled in less than a year. What happened to the stock prices of airlines in the U.S.? It was a 40% decline in price in less than a year. And there's a chart of that. When the U.S. stock sector for the housing industry peaked in 2005, buying pressure had been increasing as bullishness or optimism rose from 80% toward 90% and then toward 100%. But from that extreme of bullishness, the chance for another big increase in bullishness was negligible. Where are you going to get the next increase of 10% when you go from 80 to 90 and 90 to 93 and 96? Where are you going to get that next 10% or that next 3%? It's going to be hard to get. So the risk of an increase in selling pressure was extreme. And that's what happened. After extremes of optimism, waves of conservatism naturally follow. In other words, after extremes of buying mania, waves of selling panics naturally follow. The more extreme the optimism, the more extreme the conservative reaction tends to be. U.S. housing prices fell over 80% so far from 2005. Here's a chart of the U.S. financial sector, which also fell more than 80%, but in a shorter time period, about 2 years. The price decline was led by companies including insurance giant AIG, mortgage companies Fannie Mae, Freddie Mac, and Countrywide, plus Merrill Lynch, Bear Stearns, Lehman Brothers, Washington Mutual Bank, and other major U.S. financial institutions that all faced bankruptcy by 2008. And even months before that, the vast majority of people investing money in those companies believed those companies were stable, believed their prices of stock share were worth maybe $85 or whatever. That's what they were paying, or that's what they were accounting their shares as worth. Well, not long after that, that $85 stock share, it's the exact same stock share. It represents ownership of the exact same company. All of a sudden, that $85 share is worth 85 cents or whatever. So when people say that the market price of silver or Enron stock shares is a certain amount, that's not an indication of the market value of all silver or of all Enron stock shares. That's only an indication of the current price of a tiny portion of available shares in the context of the recent past of the relative pressure of buying or selling. If the seller's market switches to a buyer's market, like what happened with Enron when there's nobody wanted to, buy, everybody's wanting to sell and nobody wants to buy, well, there may be a sudden recognition that all the shares of that company's stock are not worth what a few of them sold for recently. A few of them sold for $85 or $7 or whatever, and hours later, days later, weeks later, people realize, wow, my particular share, it's not worth what that one that sold a week ago for $7 was worth. It's worth 30 cents or whatever. Likewise, if a buyer's market switches to a seller's market, a discounted item can rocket in purchasing power, such as the rocketing of the purchasing power of the Japanese currency, the yen, across the last 2 decades. If I had to pick 2 markets that are currently most overvalued, this is late July 2011, it would be real estate and all insurance policies. The thing about insurance policies, including the annuities sold by insurance companies, is that they are in the business of risk, yet they do not have enough money to keep all the promises that they make. Their business thrives when the dollar amount of new claims is far below the dollar amount of new revenues. In other words, when revenues far exceed the new claims that they owe out, they have to pay out. Their business, like AIG, can collapse suddenly if the dollar amount of new revenues does not cover the dollar amount owed for incoming new claims. The insurance industry is a classic Ponzi scheme of paying old claims or old liabilities out of their new revenues from current investors, out of new premiums. They have only a small fraction of the cash available to cover the vast promises that they have made at any particular time. So that's not fraud, though. That's just how the insurance industry operates. It's like when I sign a mortgage contract and say I'm going to pay $500,000, let's say, over the next 30 years. I don't necessarily have $500,000 at the time. That's not fraud. That's a promise for future payments that I don't currently have the capacity to make. Or if I get $50,000 of credit from a credit card company or a few credit card companies, that's not based on me having $50,000 cash. That's based on a promise that in the future I would pay them back, and maybe some interest or whatever the conditions of the loan are. And the insurance industry is similar. They're saying, hey, we don't have enough money to pay you $1 million of life insurance if you and everybody else that we issued a life insurance policy dies all at once. But as long as only a few of y'all die, we can make this work. Everybody pays us this premium monthly. If only a few of you die, we can actually pay $1 million or $100,000, whatever it is, whatever the policy says. We can pay that as long as only a few of you die, and as long as there's new policyholders each month. If there's not new policyholders, if there's not a growth of new customers coming into our business, there is a little problem, though, which is that we don't have the money to cover all the promises that we've made. A little bit of a problem there, like in the case of AIG. So the Federal Reserve gave AIG an $85 billion rescue in 2008, and that maintained the status quo of the U.S. Financial system for the next few years up till now. And soon that may be revealed to not be quite as stable as people might have thought it was in 2007 or 2008, 2009, whatever, or today. So the speculative optimism toward real estate may be currently even more extreme than the optimism towards insurance companies or stock prices of companies like Enron. Even after a recent 50% decline in prices in major markets like Phoenix and Las Vegas, as well as the multi-decade drop in distant places like Tokyo, the blind optimism of many real estate investors is such that they will still look to political interventions to boost their positions, to boost their investments, like a new tax credit to draw more buyers in to real estate at the expense of mainstream taxpayers. Such political redistributions of buying pressure tend to eventually produce sudden destabilizing of overall economies, as buying pressure that otherwise might have gone to something more adaptive, like energy-efficient housing or energy-efficient transportation, is instead diverted towards pouring taxpayer money towards subsidizing the value of existing buildings, like through a tax credit or whatever. So even after huge declines in real estate prices, as well as obvious warnings from other markets worldwide, like Japan, most investors in the U.S., I'm talking about, focus away from those who predicted the U.S. real estate decline and other real estate declines in other places, and instead argue about who is to blame or who should pay for government rescues of the gambling of high-risk real estate speculators. Instead of reviewing the warnings made in the 1990s or early last decade or the more recent updates from those same forecasters, many are so optimistic about real estate that they pretend that the sale prices when 2,000 units a month were being sold in a particular area will be anywhere close to the sales prices of 100,000 units are listed for sale in a single month in that same area, with all 100,000 of those sellers competing for the attention of even fewer remaining buyers than back when 2,000 a month were sold. Of course prices fell 50% quickly. Given that I, among many of those who forecast exactly that, am clear that the 50% decline is just the first wave of a much longer decline of a buyer's market, an extreme buyer's market soon. Not yet, though. I know it's going to be closer to what has manifested in Japan in the last 24 years, or maybe something much more extreme than what's manifested there. I'm clear on that because I studied some of what happened in Japan. I forecast what's happening in the U.S., and I can see the perceptions of the mainstream about prices. They just don't understand market prices. It's one of the first points I made in my first article in early 2003. What are prices? What do they represent? And how do they move? how could they be predictable? Well, I hope you found this interesting. Buyers markets and rising risk. Are there some investments that have less risk? Absolutely. The U.S. dollar, the Japanese yen, pretty darn low risk in those cases. Again, in the case of Japan, for the last 21 years, their currency, the yen, has been doing much better than the stock market or real estate prices for the vast majority of that period of time. Now, there is also an opportunity, though, whenever this isn't in the text I've written there, but there's also an opportunity whenever there's risk, there's opportunity. So there's just a lot of transactions that are about to happen all at once, and people who are in the right position can have big gains, not just by being in currency, but there are other ways of making much larger profits. And if you're interested in that kind of outcome, you would just contact me. You can reply to this blog. You can reply if you're listening to this on YouTube. Just reply. I won't. If I'm clear that it's a personal comment, I'm not going to post it onto public view. That'd be more for the case of the blog. I think for YouTube as well, I have to approve comments before they show up. If you've never sent me a comment, then it'll have to go to me for approval first. All right. Great. Thanks for listening. Thanks for being attentive and concerned about the rising risk in some of the major markets that people have been counting on as stable, that they just haven't understood what's been going on with the practices of accounting that are reasonably good estimates. If people recognize they're just estimates, they're on the high end. They're very optimistic estimates. As long as people know that's what the accounting figures are, as optimistic estimates, then it's no problem. All right. Thanks again.